a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg brief. Let's get you set up for the day. Futures pointed higher after a tech-led rally as CPI data buys more time for the Fed. The US Treasury set to auction $25 billion of 30-year debt later today at the highest interest rate since 2001. And a rare large acquisition for Anthropic, the AI giant said to be in talks to buy startup Decart AI for $6 billion. Let's get a check on markets around the world. A nice bounce in Korea now. Let's get to Winnie Su in Hong Kong for the latest from Asia. Winnie.
Yeah, good morning, Bonnie. Well, as you said, we are seeing Korean stocks leading gains in Asia today, up about 3.6%, taking it into a technical bull market, up about 22% since its July low. Now, it is on that soft CPI numbers that trimmed bets around the Fed's rate hike going forward, but also the leverage bets unwinding, plus overall solid earnings from the tech front. So those are tailwinds for the Korean market. While on the other side of things, you are seeing a bit more weakness when it comes to tech shares in Hong Kong, dragged down by Tencent's earnings. That's raised concerns around that massive AI spending, if that is going to be justified given the monetization going forward. And that has led to the memory giant CXMT to overtake the company to become China's most valuable company. Now, flip before we take a quick look at the Japanese yen, because earlier today we did see a bit of a strengthening in the yen after we've learned that the Japanese government is supportive of an earlier hike from the Bank of Japan. But those gains really didn't last, given that at this point investors want to see more action than just words.
All right, Winnie Su, thank you so much. Winnie there in Hong Kong. Now for a look at Europe, you'll see the stocks Europe 600 up about 0.25%. Narrower gauges across Europe are even higher, but it is in fact the FTSE 100 that is dragging things down for the stocks Europe 600. Metals and miners and energy companies are suffering a little bit today after a nice bounce, it should be said, yesterday. So that gauge down about 0.25%. And then we got GDP data out of Britain, which was better than expected. So for June, the economy actually grew 0.3%, helped, of course, by the World Cup. And then for the second quarter, that figure was actually 0.4%. Little bit of weakness for the British pound today, but it is still holding below 135. Let's take a look at the United States, because we saw another record yesterday for the S&P Equal Weighted Index. Dispersion, in fact, has been down this month as the AI narrative gathered pace again, down about 17.5%. But for the year to date, dispersion is still up by more than that. So that'll give you an idea. The rotation trade is alive and well. We look like we might be seeing another up day after some gains yesterday for the major indices, particularly the Nasdaq 100 off better earnings. It's been 4 quarters now that we've had 20% plus earnings for S&P 500 companies. How long can it continue? Let's take a look at yields, because we did see that 10-year auction yesterday. Decent enough demand, but a very high yield paid. And it looks like we might see something similar at the 30-year auction today. We're also seeing a little bit of steepening. So we had the 2-year yield down a little bit yesterday, continuing lower by about 3 basis points today to just above 417. Across the curve, we're down about 2 basis points, but we didn't see the decline here at the longer end of the curve yesterday that we saw in the 2-year yield. So we're still at 467.04 on the 10-year, and for the 30-year, we're seeing yields of 523.60 and not budging. All right, coming up this hour, we're going to be speaking with Priya Misra about this yield curve and obviously the Fed's path forward after Wednesday's CPI data. Let's start with tech now, though. Anthropic in talks to buy startup Decart AI for about $6 billion. Bloomberg is learning that deal would be Anthropic's largest known acquisition. Let's get more from Bloomberg's Matt Bloxham. So, Matt, what is Decart AI and why is it worth $6 billion to Anthropic?
Yeah, so Decart does 3 things. The first is that it creates real-time, live, AI-powered, high-quality video. So, for example, if you were trying on a suit, it would give you a super high-quality, real-time rendition of what you would look like in it, much better than the kind of things you see today. The second area it works in is what we call kind of world models. So it creates AI-generated interpretations of the real world, and that's really important for training physical AIs, things like robots, so when you actually deploy them in the real world, they kind of act how you would want them to. And the third thing, which I think is the most interesting thing to Anthropic, is what they call an optimization stack. Obviously, compute is a scarce resource right now, and it's also increasingly expensive. And what this optimization stack does is it allows all of the big GPUs, TPUs, so NVIDIA, Google, all the others, to get as much efficiency and performance out of their technology as possible. So you're getting a much better kind of cost efficiency from that investment. And I think that's the bit that Anthropic's really interested in, because they have incredibly powerful models. They're also incredibly expensive, and also there's a huge amount more sensitivity, particularly in the enterprise space, about the relative trade-off between AI consumption and AI cost. And I think this will kind of help them to kind of move forward a positive narrative around their ability to squeeze more technology or more out of the technology and keep their models at the top of the stack for enterprises.
Okay, so that's the Decart deal. Cerebras tumbling. It's really underperforming now after earnings. Is it that the world is just not ready for the types of chips that Cerebras is making? Data centers can't outfit themselves in order to take on these chips, or something else?
Yeah, I think that's certainly an element. Obviously, when you look at the results, there are two parts to the business. There's one, they're selling their custom AI technology, and then there's selling essentially a kind of packaged solution of capacity off the back of their own technology. And I think that the market had been looking for better growth in their actual hardware technology, not the services. And that's where the disappointment was. And as you said, these are incredibly customized chips. They're enormous as well compared to an NVIDIA chip, something like 58 times bigger, but they do deliver a much better performance. So really right now they're targeted at quite specific, super high-end deployments. They tend to perhaps more on-premise with a company or a big government agency, rather than being deployed en masse in big data centers. Now that might happen eventually, but I think inevitably that means that the kind of volume is a little bit or quite a bit smaller, and that's perhaps why the revenue's been a bit more disappointing there.
Another disappointment was Cisco, and apparently it's on its AI outlook, so it's looking for something like 10% of its revenues to be AI based. But why does that not please investors? Because in a sense, Cisco is both an AI play and an AI hedge if it's not going too much towards the AI.
Yeah, it's interesting because actually when you look at the numbers they reported and actually the overall guidance for their fiscal 2027, actually pretty good relative to market expectations. But yeah, that this element coming from AI over the next 12 months, around 10% of sales, did disappoint people. I think partly because people have seen the numbers they've reported about the order book on AI growing, and perhaps kind of anticipated that was going to come through into their numbers quicker than Cisco is suggesting. Now, it may well be that Cisco is just being kind of cautious. It's effectively going to be roughly a doubling in AI revenues year on year. So it's significant growth. And I think perhaps the management team are just trying to be prudent about how they set expectations with a view to probably beating those through the year. And so I think that's where we've kind of got the mismatch. I think people wanting just a bit more optimism from them about how big AI is going to be for them over the next 12 months.
And of course, we're in an upswing in sentiment these days as well, so I'm sure that doesn't help. Matt, thank you so much. That is Matt Bloxham of Bloomberg Intelligence. From big tech to big auctions, $42 billion of 10-year Treasury notes went on sale yesterday, hitting the highest yield since the financial crisis. Next up, we have 30-year debt later today. Let's bring in Ven Ram now to explain everything to us. So, Ven, 4.683% was what was necessary, the highest since 2007. What signals should we take from this?
Well, I think that today's auction is going to be equally interesting. I think that in the market, the off-market price is around 524, I think, and that aligns kind of with what the secondary market bids are. And I think that that pricing is going to be crucial, because 525 on the 30-year shows how far we have come. Just a few years ago, the US government could raise debt for that period, for that tenor, around 2%, 3%, thereabouts. So now we have done 250 45 basis points on that. So that's a huge shift up. And that shows really the structural decomposition of how rates are heading higher. We are in a structurally higher interest rate regime, no doubt about it. In a world where, you've got a core PCE holding above 3%, and you've got nominal growth of 2%, a 5.25% on the 30-year doesn't look unreasonable, and that's what the bond market is telling us.
Yeah, I mean, there was decent demand. It may not have knocked it out of the park, but it certainly was not lagging. And if we get the same for 30-year debt today, does that mean we can all breathe a sigh of relief? There's plenty of demand out there for US debt still.
There is still demand aligned with secondary market pricing. So that says a crucial thing, because the market, they are not able to sell anything that is not aligned with the secondary market levels, and secondary market levels are pretty high. We have moved about 45 basis points on the 30-year in just the first 8 months of the year. That's a huge shift. And over the 30-year period, that's a very big move. We can't underestimate the move. It's so I think that the markets are saying that, look, I mean, if you're going to run the kind of deficits that you're running, and if you're going to be tolerant of inflation by not raising rates, then you've got a price to pay for it. And at the moment, the price happens to be 5.25. 6 months down the line, we could be talking about a very different price, depending on where the Fed goes from here and what they do about deficits.
Now, one area where we may not be seeing as much demand is from investors who are looking to Japan instead, because also seeing Japanese rates rise, right? What happens next? Did Sanae Takeichi really lay the groundwork now for a BOJ rate hike very soon?
Well, it does look like. I mean, we had a report out of Japan this morning saying that the government is willing to let the BOJ raise rates next month. But visibly, we had a very little reaction from the yen, because what they need to be doing is putting up rates successively, as opposed to being one, okay, we'll get a token increase done in September. That's not going to solve the problem. The problem is the Bank of Japan shortchanging the bond markets, the nominal bond markets, by keeping rates really artificially low. So bondholders are being shortchanged because they are having to pick up the inflation tab, at least a part of it. So I think that message, until the Bank of Japan moves swiftly to address those concerns, the yen is not going to find respite, nor are Japanese government bonds going to fare any better.
Yeah, 159.40, creeping ever back towards that 160 mark. Ven, thank you so much. That's Ven Ram for us in Dubai. More earnings rolling in. Shares of Maersk climbing after the container shipping giant raised its full-year outlook for the second time in just 7 weeks, thanks to higher freight rates from global supply line disruptions. Maersk CEO Vincent Clerc spoke with Bloomberg.
I think the freight rates will continue to be volatile, as they have been very volatile the last 6 or 7 years. They will continue to be volatile, but I think the general environment for the years to come will be more benign, as long as the market continues to be as resilient as it has been for the past few years. Just because we are reaching some of these bottlenecks, and we are starting to stretch the capacity, and we're seeing more and more events here and there, and certainly these disruptions will be more prevalent in the future.
Joining us now is Bloomberg's Brendan Murray. So, Brendan, it seems like some of these shipping giants have been well able to deal with the different routes that they've had to take and so on. How have they been managing it?
Yeah, exactly. What they've been doing is deploying capacity where they need it when they have tightness going through choke points like the Strait of Hormuz or the Red Sea. These kinds of things the carriers like Maersk are really adapting very well to. There was some concern that we would see the first half of the year would be sort of unnatural demand tied to tariff front-running and the war in Iran. But what we heard from the CEO of Maersk was that demand is in fact strong and expected to stay strong. The underlying demand forces are strong through the rest of the year. So that was really a relief, and Maersk kept its outlook for a 4% growth in container volumes for this year. So this is really underscoring that the global trade is being driven by strong demand. We heard it from Hapag-Lloyd, Maersk's rival, and we heard it also from DP World today, the big port and logistics operator based in Dubai.
Yes, and the market really rewarding Maersk after those results. Now, the Wall Street Journal is reporting today that Mexico is pushing for lower auto tariffs in trade talks and, offering something in return for perhaps taking down American cars to 5 or 10% in terms of tariffs. Explain what exactly is going on here.
Well, this is just the incremental negotiations that are going on as the two sides try to rewrite the rules under the U.S. Mexico-Canada trade agreement. And Mexico is obviously wants to get some of those tariffs lower, whether it's steel and aluminum or autos, those 232 tariffs that the Trump administration has put in place. But the Mexican government is going to have to show some of its to give something back instead if it wants those lower tariff rates from the U.S. So what we're seeing is incremental talks going on between these two trading partners.
Brendan, thank you so much as always for all of the clarity around everything trade related. That's Bloomberg's Brendan Murray. Now to other top stories trending on the terminal this morning. The death toll from Colombia's earthquake has risen to at least 265, with as many as 3,500 injured and at least 500 missing. The president moving to declare an economic emergency to confront the fallout from the earthquake, which will grant his administration temporary authority to issue economic and tax decrees. China's CXMT has overtaken Tencent as the world's most valuable Chinese company with a market cap of $524 billion. CXMT has become a proxy trade for China's AI ambitions and semiconductor self-sufficiency push, with shares higher following its initial debut surge. And the UK economy grew by 0.4% in the second quarter, in line with economists' estimates, but with faster growth than expected in June. Businesses in certain sectors, such as alcohol manufacturing and TV production, said the World Cup boosted sales in June, while the warm weather lifted retail and accommodation. Coming up, the US reverses its strategy in Iran as negotiations fail to materialize. More next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Brent falling today after a 6-day rally as the Trump administration shifts its strategy to an economic squeeze of Iran to try and get the country to negotiate. The shift coming as munitions run low in the US and the war becomes more and more unpopular among Americans. Bloomberg's Patrick Sykes joins us now from Istanbul. Patrick, the FT is reporting that Iranian businesses are now starting to resort to things like buy now, pay later because of such economic pain. And I believe Patrick can't hear us at the moment, so we will return to that story in just a moment. In the meantime, let's get a check on markets. We do have futures pointed higher today, once again, after a rally yesterday. Not a massive rally, but nonetheless, we did have another record for the equal weight S&P 500. As you can see, Brent crude down 2%, helping things a little bit, taking the pressure off. We've had a 6-day rally in Brent and in WTI as complete uncertainty over the Strait of Hormuz continues. So S&P futures up 0.1%. That CPI data helping as well. And we are looking forward to the PPI data later today as well, which obviously will feed into the CPE, the core PCE index that the Fed will be looking at as well. So I think we can get back to Patrick Sykes now. Patrick, the FT is reporting that Iranian businesses are really hurting and they're resorting to things like buy now, pay later. Can Iran withstand economic hurt for a long time to come, longer perhaps than the US can withstand it?
It can withstand. It's made something of a name on its status as a resistance economy. That was always a stalwart of the policy under all the years of sanctions that Iran has faced with. The question really is how long it can do so, and more specifically, how long will Iran's ability to resist last out relative to the US's ability to ride out the impact from the Strait of Hormuz, the US and of course the global economy more broadly. But for Iran, I think, in terms of how the regime operates, we can expect them to double down on this strategy. It's not new for them to sort of try and find creative workarounds to keep the economy going. I think we can expect to see a lot more of that, and they'll continue to put that defiant point in public and try and pressure Trump to make a move under pressure from the Strait of Hormuz.
All right, Patrick, thank you so much for your contribution. That is Patrick Sykes there in Istanbul. Coming up, the CIA doubted Israeli intel on that threat to President Trump before that switch of planes in Turkey. More on that story and what else is making headlines in your front page news. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York, and it's time now for your front page news. First up, the Financial Times reporting Anthropic investors expected to float at a valuation of $2 trillion or more in October. That figure would eclipse SpaceX and make Anthropic the largest ever IPO. Half a dozen of the company's backers told the FT that Anthropic's rapidly rising revenue would allow it to more than double its current valuation in that IPO. Next up, the Wall Street Journal leading with Alphabet's top scientist, Demis Hassabis, reportedly holding discussions with government officials and leaders of other AI labs about forming a new independent industry safety entity. Hassabis has likened the proposed entity to the International Atomic Energy Agency. And finally, the Washington Post leading with reporting that US intelligence officials were skeptical of an Iranian assassination threat against President Trump that was relayed by Israel. The Post says the White House and Secret Service decided to take precautions and secretly fly Trump out of Turkey in an alternate military aircraft, despite doubts about the intelligence. This is your macro picture going into your session today, Thursday. Futures pointed higher, a little weakness for the dollar index, and the 10-year yield holding just below 467. We're going to talk to JPMorgan's Priya Misra next about all of that. It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Futures are pointed higher after a tech-led rally as CPI data buys a little more time for the Fed. The US Treasury set to auction $25 billion worth of 30-year debt later today at the highest interest rate since 2001. And a rare large acquisition for Anthropic, the AI giant said to be in talks to buy a startup, Decart AI, for $6 billion. So we have S&P futures pointed higher. NASDAQ 100 futures are actually wavering. We did have a nice gain for the NASDAQ 100 yesterday. It was up 0.7%. The SOX index was up 2.5%. So I wouldn't be too surprised if that changes, but we did have a few disappointing earnings overnight, including Cisco. The market not reacting too well, even though it did beat. Russell 2000 futures up 0.2%. And to that point, we did have another record yesterday for the S&P equal weighted index. Dispersion has fallen this month, but it's still up about almost 18%, in fact, on the year. Let's take a look at yields, because we did see the two-year yield drop a little bit, and down another 3 basis points today to 417. We didn't see the rest of the curve drop as much, but we're down about 2 basis points today on the 10-year 467.04 with that auction out of the way. Coming up, we have that 30-year auction and that yield at 523.49, certainly being watched by investors. One other thing to note, the VIX is trading at a 14 handle, so this market lulled into a lot of calm and maybe even complacency. Joining us now at the desk is Priya Misra, Portfolio Manager at JPMorgan Asset Management. To that point, Priya, the MOVE index is also not too bothered these days. I mean, we have seen a little bit more movement there than the VIX, but is this market ignoring potential, shocks that could be coming down the pike?
So I think when you look at valuations, you can argue that everything's priced for perfection. But then I look at fundamentals, and the economy is extremely resilient. It's had to deal with one shock after another, supply shocks. But the economy, economic data has been solid. Now you look under the surface and you try and see, is the economy overheating? Will the Fed have to come in and raise rates and actually bring, growth lower? We're not really seeing that. We had two important, data releases over the last week. Payrolls, I think it sort of overestimated the weakness here, but you look at wages, you're not seeing a pickup there. You look at CPI, look under the hood, inflation has sort of peaked. And so I think the market's saying maybe the urgency for the Fed to raise rates is not there. We can actually hang out here. If inflation continues to decelerate, the Middle East sort of stabilizes somewhat, then we can just stay here. So I think it's sort of priced in a way, but obviously there are risks, and we're watching. There's a lot of supply. These interest rates are rising. It's not impacting much of the IG supply, but we're watching, does the demand for fixed income start to slow? And that hasn't happened. I think people are looking at all-in yields and flocking to fixed income.
Yeah, even yesterday it was pretty decent demand. Would it be going too far, though, to say that we're in a Goldilocks economy? Because as you say, wages are not rising as much as we would like, and there are still definitely at least external events that could really challenge this. And we also haven't solved the inflation problem.
Right. So I wouldn't be a bond investor if I don't worry about all the downside risks. So I say Goldilocks or soft landing with, just keeping an eye on the risks. So to your point, the risks on the downside would come in if you see valuations start to, if there's just a lot of AI, issuance, capex build, and there's questions about monetization, and it does some of the air come out of the AI trade, I think that would be on the downside. On the upside is this inflation fear, and maybe a reassessment that the neutral rate is higher. We're hearing some Fed officials bring that up. And then they would have to hike. Even if inflation's decelerating, they might say policy is too accommodative. I think that's the debate right now. Is policy in the right place? And I think for different parts of the economy, it is restrictive. And then for the AI side, it's not. So we're mindful of the risks. I think this is why you have to be careful about sizing. We like credit, but are we all in? No, because there's just a lot of supply that's going to come in and spreads are still tight. So just being mindful of the risks on both sides. But I would say we're in a pretty good place across the market right now.
That would be a huge structural shift, or it would indicate a huge structural shift has already taken place in the economy if they change the neutral rate, wouldn't it, Priya?
I think if there's consensus that the neutral rate is much higher, yes, then we're talking about rates being higher, the Fed having to hike. I think the jury's out there on that front. When I look at wages, I look at demand. So inflation's absolutely above target, and that's why the hawks are saying let's hike. But I think, you look at demand-led inflation, we're not seeing signs of that. Wages are not, picking up. The unemployment rate fell, and yet it doesn't look like companies are paying up for workers. If that starts to happen, I think then the neutral rate estimate starts to go up. Then we're talking about a higher level of rates. And then we look at what point does this constrain demand in the economy? I don't think we're there yet. I'd like to see it. I mean, we get PPI, PCE. These are all important measures. But the overall demand side of inflation doesn't suggest that the neutral rate should be much higher.
So we've moved 45 basis points right on the 30-year yield in the last few months. And, we're citing this statistic that the auction today could go off at the highest yield since 2001. But does that really mean anything? Because we were in this crazy zero rate environment for so long that, so what that it's the highest in 40 years? Of course it is. We've come out of that regime now.
So great point. I think the level of rates are higher. But you go back, go back all the way to the late 90s when we were in the last big productivity boom, and then they don't look that odd. What would concern me is if the auctions themselves are not seeing demand, or do we not see a couple of oversubscribed books on the corporate side? And we're seeing that. Auctions, I mean, yes, the rates are higher. The auctions are going fine in the Treasury market, in terms of tails, we're barely seeing any tails. In terms of the corporate side, there's demand. So I think people are looking at these yields and saying there's income in fixed income. I also get that diversification. If the economy slows down, there's potential for price performance. So the demand side, yes, there's a lot of supply, but the demand side is still there. So I'm kind of with you. These are good level of yields. I actually don't want lower yields. We don't want to go back to that zero rate environment. But there is uncertainty around how much supply is going to come in, where's that neutral rate, uncertainty about the Fed reaction function. I think this is all, it's a lot of cross currents that the Treasury market's dealing with.
And there's also the question of global yields, right? So they're rising everywhere. Right. Is there the potential for a meaningful shift to other countries' debt just simply because it's better value?
Right. So there's a lot of competition for capital. I mean, I talked about the AI trade, but then there's global rates. And I think, yes, if I'm a global investor, I have the US market, but now I can go to JGBs. But I think that's where if the BOJ does hike a little sooner, some of that credibility issue starts to come out of the JGB market. I think you get stability in global rates. It doesn't mean that the Treasury market will see a lot of demand, but it can actually bring some, more sense of equilibrium. I still think the growth is in the US. The US is outperforming on a growth basis, is leading on the AI trade. So that's why I still think we're not seeing signs of sell America, but absolutely, if global rates are higher, that does put upward pressure on US rates too.
I have to ask you about the $500 billion platform that was formed, let's say, in committee with Jensen Huang and some of the Wall Street giants, right? Does that just put a nice little bow on the fact that there's going to be lots and lots more financing. And aren't these just going to be lots more products coming to the market? What are you anticipating will come out of that?
So we are looking for a lot more supply. I mean, we've already seen supply at a much higher rate this year, and that's going to continue. It's unclear on the 500 how much is equity, how much is debt. And issuers are being creative about how they're issuing it. There's unsecured debt, there's data center 144A, SPV type structures. So there's different ways that they're issuing. So we're being creative on the investor side. But I will say, I look at number one, fundamentals. Are we overbuilding on CapEx? And we don't see signs of that. We think demand for compute is still higher than the supply. And then we look at investor demand. And I think people are looking at these all-in yields and buying. We just want to be careful if there's a lot more supply coming in. Maybe we want a little bit more concession. And you've seen this in some of the AI deals. The concession has been higher. So we're getting 15 basis points, for example, more at new issue. I think that's going to be the IG market, which was unheard of in the investment grade market, getting that sort of concession. I think that's going to be the new normal. We get paid up to take on that risk. And I think we just want to be mindful that we're not all in because there's a lot of supply coming in.
And you'll take the 15 basis points. Just to that last point briefly, if you don't want to be all in on AI, which would probably be the prudent thing to do, where else are you looking for IG credit?
So securitized credit is another area that we see a lot of value in. It's not part of the index. So when you're an active fixed income manager, you can go outside the index. And what that's taking is ultimately credit risk of the corporate, of the consumer. We can look at the collateral. So I'd say there's some emerging market debt. There's a lot of opportunities across fixed income. And unlike the equity market where it's all AI, we've got a more diversified playbook.
Good time to be a bond portfolio manager. Priya, thank you so much for joining us this morning. That is Priya Misra of JPMorgan Asset Management. Now to other top stories trending on the terminal this morning. First up, Ukrainian President Volodymyr Zelensky is increasingly unhappy with the governor of the Ukraine Central Bank, viewing him as being too close to the IMF and not doing enough to support the wartime economy. Sources telling Bloomberg that Zelensky doesn't plan to remove the central bank chief, at least for now, as he also doesn't see strong candidates to replace him. Reclusive billionaire Kenneth Dart's Candle Lake launched a mandatory cash takeover for Evolution, valuing the Swedish betting company at about $13.8 billion. Evolution has grown into one of the online gambling industry's biggest suppliers of live casino games since its 2015 Stockholm listing. And Sicily's Catania airport will remain closed until early Friday due to eruptions from nearby Mount Etna that have forced hundreds of flights to be cancelled or rerouted over the past week. About 700 flights have been affected since August 7th, after Europe's most active volcano began its latest flare-up. Coming up, Brent falling after a 6-day rally as the US signals an economic squeeze on Iran. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. The US shifting to an economic squeeze on Iran as munitions run low and the war becomes less and less popular among Americans. Joining us from Washington is Jonathan Tamari of Bloomberg Government. Jonathan, I'm tempted to ask if the US has any other option given what I just laid out. It's an extraordinarily unpopular war. The president has extraordinarily low favorables right now, and munitions in certain areas are running low.
Exactly, and that does limit his options, especially as we approach the November midterm elections. With the war being unpopular, the thing that would make it even more unpopular is having to escalate it again, having to increase the costs, potentially sending in ground troops if he wanted to advance the military action. Bombing has not worked, so they're going to turn to try to increase the economic pressure. There's some suggestion that maybe that could work. The world has weathered the higher gas prices, I think, better than many people predicted. But at the same time, there have been economic sanctions on Iran for a very long time now, and they have not brought the regime down. And the regime is fighting for its life, so it may be willing to endure economic pain that many others would not.
Yes, and we are hearing of reports of economic pain out of Iran. But again, as you say, potentially it could last a long time. Iranian businesses, according to the FT, offering buy now, pay later options and so on. Now, domestically, a bit of a bombshell. Karoline Leavitt stepping down as US press secretary. Who will the president replace her with?
It's a good question. I don't know if we know. It's going to be a difficult person to replace because she channeled her boss very, very well. She was defiant. She was combative. She'd worked for him for a long time and kind of knew how to channel his voice and his images, or his messages, I should say. At the same time, Donald Trump is really his own spokesperson, more so than probably any other president we've seen. He is available to the media very often. He often contradicts his top aides, including his press secretary. So he is the main voice of the administration. It will still be a significant change to not see Karoline Leavitt there behind the briefing podium every day or most days. But the president is the top messenger here. So I don't think the message will change. It may be the face obviously will.
Jonathan, many of the primaries are out of the way now, still some significant answers to get, but what will be the result of all of the primaries in terms of path forward for the Republicans, also for the Democrats? What lessons have been learned?
I mean, there's a number of contradictory lessons you might see from the Democratic side, because we've seen the more progressive side, Democratic Socialists, have some significant success, including in Michigan, one of the most important states in the country this year for the Senate. But last night, then, we saw the establishment score a pretty big win in Wisconsin, another major state where there's a key governor's race. So there are mixed messages there. I do think what you are seeing is that there is a desire for change among the Democratic side, not just change of Republicans, change within the Democratic establishment. A lot of older Democrats have been voted out. Democrats who have pretty liberal voting records have been voted out because they've just been in office for a very long time, and people want fresh voices, fresh approaches, fresh faces on the Democratic side. And in some cases, these might be risky choices. They're different than the types of candidates the party has often won with in the past. But there's a huge dissatisfaction with the way the party has handled Donald Trump, and voters are looking for somebody different. That has been consistent, establishment and progressive side.
Jonathan, thank you so much for joining us this morning. That is Jonathan Tamari of Bloomberg Government. Turning to tech, sources telling Bloomberg Anthropic is in talks to buy startup Decart AI for nearly $6 billion. Decart's chip efficiency software would help Anthropic's infrastructure absorb more demand for its AI models. Let's get more from Matt Bloxham of Bloomberg Intelligence. It's a whopping figure to pay for a company. What does Decart do so well that Anthropic needs it, Matt?
Yes, so three things this company focuses on. Firstly, live AI video creation. So if you are trying on a suit or something, you can see yourself in it in super high quality, much better than the web-based tools we have right now. That has all sorts of uses that could be quite powerful. The second area is what we call world models. So it creates virtual real-world environments that you can use to train physical AI, so robots and drones and sensors. So you kind of check everything out and help them to understand their environment before you actually put them into the real world. That's a hugely big opportunity. The third and perhaps most important area, though, for Anthropic is this optimization stack that Descartes has. And this basically allows the likes of NVIDIA and Google with their processing units to kind of squeeze as much out of things as they can in terms of performance and efficiency, and that's becoming increasingly important given the scarcity of compute and the cost of compute. So everything that Anthropic can do to kind of help the technology squeeze as much performance out of their models as they can is going to be crucial. So I think that's going to be an interesting addition to their equity story if indeed this deal goes through.
Cerebras came in with earnings underwhelming investors, stock selling off massively. Is the world just not ready for its larger chips, Matt, or what's the problem?
Yeah, I think it's perhaps that the current market opportunity for their highly specialized AI chips isn't quite there yet. Actually, what we saw in the results with better than expected performance on their service arm, so providing end-to-end compute capacity. And, we're seeing time and again that it's that compute capacity that the market's looking for. The actual processor units they create, which are incredibly large, almost 60 times as big as an NVIDIA equivalent, but much higher performance. Now, they're really kind of designed for highly specialized applications, not necessarily to be deployed in big data centers, but perhaps on premise at a big pharmaceutical company, for example, or a big government agency. agency. And so that market is perhaps a bit slower to grow and inevitably will be smaller. And I think that's where the market's been looking for stronger growth, and they fell a little bit short.
Cisco was another head scratcher. So it said 10% of its revenue would be due to AI. Now, let me get this straight. Investors want more participation in AI, but they don't want companies to spend too much either. So there doesn't seem to be any sweet spot here. I would have thought that Cisco's results would prove that it's participating, but not overly dependent.
Yeah, that's right. Although I think the market's looking for more dependence on AI than they're suggesting. So they're talking about maybe 10% of fiscal 2027 sales coming from AI. That would be a doubling year on year. But I think the perception is that Cisco's perhaps been a little bit behind the curve on transitioning to be an AI-led company. That's made investors worry that perhaps they'll get left behind. And although they've kind of been making this pivot to be much more AI-led, I think the market's just been looking for it to kind of happen quicker. And maybe there's just a sense of kind of conservatism here in the management team in terms of where they want to pin revenue for the next 12 months, I guess probably with an eye to hopefully beating that guide. But yeah, for sure, the market was hoping there would be a bit optimistic from the get-go.
And I should mention it has been close to records already, so it's not like it's selling off massively. Very briefly, Lenovo shares higher. It's basically turned itself from a PC maker into a server maker, and we all know what that means.
Yeah, absolutely. Kind of great numbers. Talking about $100 billion of revenue for the next calendar year, which is probably maybe about 5 or 6% ahead of market expectations. And as you said, playing into this theme that actually there's a huge amount of demand for servers in data centers that do the actual inferencing. So not the super high-end GPUs that NVIDIA develops, but the more CPU end of the market for actual kind of day-to-day inference. We've seen a number of other companies benefit from this kind of pivot, if you like, and Lenovo is definitely one of those. So yeah, their PC arm perhaps a bit in the shade right now, but they've kind of done a really good job at tapping into that server opportunity.
All right, quite the array of companies reporting. Thank you to Matt Bloxham of Bloomberg Intelligence. Coming up, more inflation data will get you set up for your trading day. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. Starting off with Fed Speak. We get some speak from Cleveland Fed President Beth Hammack at 8:15 a.m. Eastern. And that's followed by Richmond Fed Tom Barkin speaking at 8:40. More data, very important PPI data, also initial jobless claims at 8:30, and of course the auction at 1 p.m. And then we get earnings from Applied Materials after the market close. Speaking of earnings, some movers this morning. Cerebras extending its decline in the pre-market trade after an underwhelming growth outlook. The market perhaps just not ready for its chips. Coherent, another optical play, so it was higher yesterday going into earnings, but second quarter forecasts failed to impress investors. It is, though, close to its highs. And StubHub with a massive sell-off. Earnings missed the street's estimates. Analysts noting the company's forecast also underwhelmed despite that World Cup boost. This is Bloomberg Brief.